So Chapter 12, long-term liabilities. Learning objectives, journalized transactions for long-term notes payable and mortgages payable, describe bonds payable, journalized transactions for bonds payable and interest expense using the straight line amortization method, journalized transactions to retire bonds payable, report liabilities on the balance sheet, use the debt to equity ratio to evaluate business performance. Use the time value of money to compute the present value of future amounts, and journalize transactions for bonds payable and interest expense using the effective interest amortization method. Objective 1, we're going to journalize transactions for long-term notes payable and mortgages payable. Long-term liabilities, and this is on page 597. So long-term liabilities are liabilities that do not need to be paid within 1 year or within the entity's operating cycle. These liabilities are reported in the long-term liabilities section of the balance sheet. Common long-term liabilities are long-term notes payable and mortgages payable. Long-term notes payable. So on December 31st, Smart Touch Learning signed a $20,000 note payable. It's due in 4 annual payments of $5,000 plus a 6% interest each December 31st. So we recorded this journal as a debit to cash and a credit to notes payable for $20,000, and our note in our memo says received cash in exchange for a 4-year 6% note. So I know that I've mentioned this before, but we want the note, the memo area, to be short, but also include information that can easily tell someone else what's going on. The more detail that you put in the note, normally the less likely they are to come and ask questions later. And that actually can be a big deal for you in the workplace, because if you don't put a lot of detail in there, you're going to have a lot. You may potentially have people emailing you often or calling, hey, I saw this journal entry, and what is this for? And it just, trying to think of the best way to say this without saying it's a waste of time, because it wastes your time in a sense. You already done it. Why are you looking at it again? Sometimes you may not even remember. You may be like, oh my gosh, I did that a year ago. Why did I create that journal entry? Now I have to figure out what was going on so that I can answer this person, when in the beginning all I had to do was take maybe an extra 2 minutes to write out a memo, and boom, I never have to hear from anybody. So it can help out in the long run. You don't want it to be a paragraph, but being able to put some detail in there can really help. And in this example, we see they put the time period 4 years and the percentage 6%. If they had put received cash in exchange for a note, it's missing some information, and that leaves room for questions and people having to come back. So you want to try to put some detail in there if you can. An amortization schedule details each loan payment's allocation between principal and interest and the beginning and ending balances of the loan. Interest is computed as beginning balance times your interest rate times the time or the period. So here we have, when a loan is taken out, an amortization schedule is created. So if you have a car loan or a house loan, more than likely there's an amortization schedule with the creditor or whoever is providing the funds to make this purchase. This amortization schedule shows payments and interest over time or over the term of the loan. And this is on page 598. And it shows here, so we started out with $20,000. And on December 31st, so on December 31st, 2016, our ending balance was $20,000. On December 31st, 2017, our beginning balance was $20,000. And then we had a principal payment made of $5,000. We also had some interest expense of $1,200, and they tell us how they calculated that down here. So this is a good slide to refer to, or page in the book to refer to. So they're telling us to calculate the interest. We took the beginning balance times the interest rate times the time. So 20,000 times 6% times 1 year. And that gave us the $1,200 for the interest expense. We see our total payment amount here. And so this is telling us how to calculate our total payment. So we've got our principal payment plus our interest expense. And our principal payment was $5,000. Our interest expense was $1,200. So the total amount of the payment is going to be $6,200. And now we have to calculate our ending balance. Most people might assume that our ending balance would be $20,000 minus our payment, but that is not. So our ending balance is going to be the beginning balance minus our principal payment. 20,000 beginning balance minus principal payment of 5,000 equals the ending balance of 15,000. So just make sure that you keep that in mind. So when you take out a loan to buy a car, let's say this is a loan for a car and we're taking out a loan for $20,000 to buy a car. When we are making our car payment, some of that is going to the car loan and some of that is going to the interest. We, as a buyer, are probably paying this, but the company that is loaning us the money that is created an amortization schedule on this, they are applying a portion of our payment to the principal, and they are applying a portion of our payment to the interest. So when they are keeping track of our loan balance on our amortization schedule, they are taking our beginning balance minus the amount applied to the principal equals the ending balance of the loan. And so the journal entry for this, we would show a debit to notes payable, a debit to interest expense, and a credit to cash. And they paid principal and interest payment. Mortgages payable. Mortgages are long-term debts that are backed with a security interest in specific property. Mortgages payable are similar to long-term notes payable, except that mortgages payable are secured with specific assets, and long-term notes payable are not. So on December 31st, 2016, Smart Touch Learning purchases a building for $150,000. They pay $49,925 in cash and sign a 30-year mortgage for $100,075 with a 6% interest with $600 payments beginning in January. It's a lot of information. So when we're creating our journal entry, we're going to debit our building for the full amount of $150,000. That's what's going into our building account. Our mortgage payable account, it says that we signed a 30-year mortgage for this amount of money. So our mortgage payable account is going to be $100,075. And it says that we paid cash of $49,925. So the amount of cash will be $49,925. This information down here, we don't need currently for this journal entry. This is just additional information. So don't let that confuse you if you see problems like this. For this particular part, we do not need that information. And so we purchased a building with a mortgage payable and a cash payment would be our note. Then over here on this next slide, we see we have our amortization schedule. This is also on page 599 in your book. So we started with a beginning balance of $100,075. We have a principal payment amount of $99.62, and they show us how to calculate that. So to calculate it, we have our total payment minus our interest expense. So one way that I tell people, if you have a problem similar to this, is to use a piece of paper and maybe just draw it out on paper. Like draw everything out on paper first. So take your like just go ahead and just make a couple columns so that you can fill everything in. So you would just like do like this. And then, I don't know if I did enough columns, but you have beginning balance, principal payment. That's the date. So beginning balance, principal payment, interest expense, total payment and ending balance. Total payment and ending balance. And that's the date. And then you would just kind of like go from there and plug in what you have. So in this first one, if they were asking us, well, if we're trying to figure out the principal payment, then we wouldn't have any information here. But they probably would tell us some other information, and then we would just have to do a calculation to find the principal payment. So for some people, it may be easier to draw this out, plug in the numbers you already have, and then solve for the ones that you don't. Or you can use the formulas. And they do tell you the formulas here, and you could just write the formulas out. It's whatever's easier for you. If you write it out this way, you'll have your full amortization schedule, which some problems need and some problems don't. So you do need to know how to do it. You do need to know how to do it this way. And when you do it this way, you're still using the formulas to calculate everything. You're plugging your numbers in first. But here we've calculated our principal payment amount to be $99.62. For our interest expense, it tells us to calculate our interest expense, we take the beginning balance times our interest rate times the time. So for this one, we took $100,075 times the 6% interest times 1/12, because it's 1 month over 12 months. And so for this particular month, and we know that it's monthly because if we look at our amortization schedule and we look at the dates, they're going up a month. So that's how we know that this is monthly. And so right now we're calculating the interest expense only for the month of January. So it's 1 month, and so that's how we know it's 1/12. For the ending balance, you take the beginning balance minus the principal payment. So $100,075 minus $99.62 equals $99,975.38. And then they're just saying, notice that as time goes by, the portion of the payment applied to the principal increases. So if you look at your principal payment column, you'll see that over time, when we make these payments, the portion that's going towards our principal tends to go up. And if you look at interest expense, the portion going to our interest expense tends to go down. So in the beginning of the loan, we tend to pay more for interest and less for principal. But as time goes on, the amount that we're applying to principal tends to go up, and the amount being applied to interest tends to go down. So Smart Touch Learning records the first mortgage payment by debiting mortgage payable, $99.62, and interest expense, $500.38. It then credits cash for $600. So here in our journal entry, we see the debit to mortgage payable, the debit for interest expense, the credit for cash, and our note is that we paid principal and interest payments. Does anyone have any questions on those? Okay. All right, so next we're going to talk about bonds payable. So bonds are long-term debits that are issued to multiple lenders, and those lenders are called bond holders. And usually they're in increments of 1,000 per bond. Face value is the amount a borrower must pay back to the bondholders on the maturity date of the bond. So face value equals maturity value equals principal amount equals par value. We'll come back. So the maturity date is the date on which the borrower must pay the principal amount to the bondholders. It's the date that it matures that the principal amount is due. It has matured. The stated interest rate is the interest rate that determines the amount of cash interest that the borrower pays and the investor receives each year. So the stated rate equals the face rate equals the coupon rate equals the nominal rate. This is a picture of a bond. So this is what a bond typically looks like on page 601 as well. You will see the issuing company name, which is the borrower. The maturity date will be on there showing when this bond matures. The annual stated rate will also be on there. So in this case, we're looking at a 9% bond. And the face value of the bond will also be on there. So term bonds are bonds that all mature at the same time. Serial bonds are bonds that mature in installments at regular intervals. Secured bonds are bonds that give bondholders the right to take specified assets of the issuer if the issuer fails to pay the principal or the interest. And debentures are unsecured bonds backed only by the credit worthiness of the bond issuer. A bond can be issued at any price agreed upon by the issuer and the bondholder, and a bond can be issued at any of the following. So we can issue a bond at face value. We can issue a bond with a discount on bonds payable or a premium on bonds payable. A discount on bonds payable occurs when the issue price is less than face value. A premium is when the issue price is more than face value. This is on 603. So Exhibit 12.4 shows example price information for the bonds of Smart Touch Learning. So here we're saying that we have a bond. The volume is 12. The high for the bond is 79.5. The low is 78.45. And the close is 79.5. Present value Money earns interest over time. So the time value of money is the recognition that money earns interest over time. The present value is the amount that a person would invest now in order to receive a greater amount in the future. The stated rate is the rate printed on a bond. The market interest rate is the rate that investors demand to earn for loaning their money. So here we see this example of a bond with a stated interest rate of 9%. And so we have the bond's stated interest rate is 9%. If it equals the market interest rate, then the issue price of the bond was the face value of the bond. The stated rate equaled the market interest rate. It was at face value. If the stated rate is less than the market interest rate, then it was a discount. The price fell below face value. The price fell below the face value. If it's a premium, then the stated interest rate was greater than the market interest rate, then the price was above the face value. So issuing bonds versus issuing stock. Borrowing by issuing bonds payable carries a risk. The company may be unable to pay off the bonds and the related interest. However, debt is a less expensive source of capital than stock, and it does not affect the ownership percentage. Earning more income on borrowed money than the related interest expense is called financial leverage. So here we are issuing bonds payable versus issuing common stock. This is a good example to refer back to. So we're comparing the two different types. And so we started with 300,000 in both. So in plan 1, we issue 500,000 of 10% bonds payable. In plan 2, we issue 500,000 of common stock. Net income before the new project for both of these is 300,000. Our expected income on the new project before interest, income taxes, expense is 200,000 for both. And then we have to take out our interest expense, and our interest expense would be 50,000 with plan 1. So now our project income before income tax for plan 1 is lower. It's 150,000, whereas with plan 2 we're still at 200,000. Then we have to take out the income tax expense, which is at 40%. So 40% of 150 is 60. 40% of 280. So now we're looking at our project net income for plan 1 is 90,000. Our project net income for plan 2 is 120,000. So which plan looks better? If we're looking at our net income, which plan would you go with? Let me see. Do I have? I know I have one somewhere. Where is the highlighter? I'll just do this. All right, so we're looking at, so we've gotten all the way down to our net income. So for plan 1, our net income is 90,000. For plan 2, our net income is 120,000, and net income is revenue minus expenses. So judging on, if we base everything off of just our net income, which plan are we probably going to choose? based on net income. We'd probably choose number 2 because our net income is higher, right? We have more net income with this plan. But then we have this net income with our new project. So we can't stop there. Some people do though. So I'm just saying don't stop there. Make sure you finish, you continue through. So the net income with the new project, we've got the 30,000 and the 90. So that's 39, that's 420. Well, this is a really good deal right here, right? Because this is higher. So we probably want to stick with that plan too. But then you have to factor in your earnings per share. So when we look at our earnings per share, to calculate the earnings per share, you're going to take your earnings, your net income, and divide that by the number of shares. And in plan 1, we have 390,000 divided by 100,000 shares, and that gives us an earnings per share of $3.90. For plan 2, we're going to take the 420,000 net income and divide that. We had 150 shares. So when we divide that by 150 shares, our earnings per share is $2.80. So basing this off of our earnings per share, which one do we think is better? One. Because the earnings per share means that per every 1 share, we're earning $3.90 versus per every 1 share, we're earning $2.80. So the net income might be better over here, but the earnings per share is better here. Does anyone have any questions? Okay. All right, so journalize transactions for bonds payable and interest expense using the straight line amortization method. Journal entries are required to record the issuance of bonds at face value, discount, and premium. And bonds are a long-term liability. So here, Smart Touch Learning has 100,000 of 9% bonds payable that mature in 5 years. The company issues the bonds at face value on January 2016. So we're going to debit cash for 100,000, credit bonds payable for 100,000, and we issued bonds at face value. Then we have interest payments that occur every June 30th and December 31st. Smart Touch Learning's first semi-annual interest payment is journalized. We're going to debit our interest expense and credit cash. And to calculate the interest expense, we took the 100,000 times the 9% times the time. And in this case, it is 6 months. So 6 over 12. And that gave us the 4,500. Our note is that we paid semi-annual interest. Semi-annual, 6 months. Next, Smart Touch Learning issues 100,000 9% 5-year bonds that pay interest semi-annually. The market rate of interest is 10%. Smart Touch Learning actually receives $96,149 and records a discount of $3,851. So we're going to debit cash for the $96,000. We're going to debit our discount on bonds payable for the $3,851 and credit our bonds payable account. And they show here how they calculated the discount. So to calculate the discount, they took the 100,000, which was the issue of the bond, and they subtracted out the cash, and that left the amount that was discounted. Discount on bonds payable is a contra account to bonds payable. Bonds payable minus the discount gives the carrying amount of the bonds, which is also known as the carrying value of the bond. We can amortize a bond discount using the straight line amortization method. This is on page 608. And here they're showing us all of our different calculations, how they calculated each of these. So we started with our date, and then we have cash paid. So every 6 months, we are making a cash payment of $4,500. And then part of that cash payment, so we've got our interest expense, and we also have a discount that is coming through, and then we're going to be left with the carrying amount. So on June 30th, we paid $4,500 cash. $4,885 went to interest expense. $385 was discounted. And so that leaves us with a carrying amount of $96,534. And you can read in here the formulas and how they calculated each of those. To calculate the discount, you would take the discount, to calculate the discount amortized, you would take the $3,851 divided by 10, which gave you the $385. All right, so using the discount amortization table, we're going to record Smart Touch Learning's first interest payment on June 30th, 2016. So June 30th, 2016, we're going to debit our interest expense for the $4,885. And they show here that we calculated the interest expense. We took the $4,500 plus the $385, and that gave us our total amount for interest expense. We're going to credit our discount on bonds payable for $385. They're showing us here that we found our discount on bonds payable by taking the $3,851 and multiplying that by 1/10. And then for cash, we are going to credit $4,500. And they show us here that we calculated that by taking the 100,000 times 9% times 6/12 for semi-annual. And our note is that we paid semi-annual interest and amortized discount. So they're showing us our formulas in all of these lines here as well. So when the stated interest rate is greater than the market interest rate, the bonds are sold at a premium. When the stated rate is greater than the market rate, the bonds are sold at a premium. A premium on bonds payable is an adjunct account to bonds payable. An adjunct account is an account that is directly related to another account. Smart Touch Learning issues its 9% 5-year bonds when the market interest rate is 8%. Assume the bonds are priced at 104.10. And Smart Touch Learning receives $104,100 cash upon issuance. So we're going to debit cash for that full amount of cash received. We're going to credit premium on bonds payable because they were priced at 104.1. So we're going to credit our premium on bonds payable. So we're going to take that 104,100, subtract out the 100,000, and that tells us that our premium on this bond was 4,100. And then our bonds payable, because it was a $100,000 bond, our bonds payable would be credited 100,000. So we paid this for it, but this is the bond. So this is the premium that we have. This is the premium that we received on it, which is the difference between what was paid and the value of the bond. That's the premium. And we issued bonds at a premium. So the beginning premium is 4,100, and there are 10 semi-annual interest periods during the bond's 5-year life. Therefore, of the 4,100, $410 of the premium is amortized every interest period. So we have to debit our interest expense for this amount, and they found that by taking the 4,500 minus 410, and that gave them the 4,090. For the premium on bonds payable, we are going to debit 410. And for the premium, we found that by taking the 4,100 times 1/10. They're semi-annual, but there's 10 semi-annual interest periods. And so we're looking at one period, so we're going to take 1/10. And then for cash, we're going to credit the full 4,500. For cash, we take the value, which is 100,000, times the interest, which is 9%, times the time, and it's semi-annual, so that means it's 6 months out of a year. So we're going to use 6/12 for this one.
Wait, where did the 9% come from?
Let's go back. Right here.
Okay.
They issue it at 9%.
Okay.
Good question. And then our amortization schedule, we have, let's see, this is 12/8, so we're on page 611. So for our amortization schedule for this one, same type of layout. I'm not going to read through all of these, but you can see here they do show the cash paid. They show our interest expense. They show our premium amortized. They're showing us how we calculated each of these. So to calculate the cash paid, you do this. To calculate your carrying amount, etc. And at the end, your cash paid should total the 4,500. And then you'll also see what your total interest expense was and what your total premium was. And your carrying amount, so we started with 104. We're going to end at 100 because we're just looking at the premium right here. And so our total premium amortized is the 41. Does anyone have any questions so far? Okay. Journalized transactions to retire bonds payable. So retirement of bonds payable involves paying the face value of the bonds. Bonds can be retired at the maturity date or before it. When a bond is matured, the carrying value always equals the face value. Smart Touch Learning has 100,000 9% bonds that mature on December 31st. Note that all interest has already been paid and the discount is fully amortized. So we're going to debit bonds payable for the 100,000, credit cash for the 100,000, And our note is that we retired bonds payable at maturity. Companies sometimes retire their bonds prior to maturity. The main reason is to relieve the pressure of paying interest payments. Some bonds are callable bonds, which means the company may call or pay off the bonds at a specified price. So on December 31st, 2016, Smart Touch Learning has 100,000 of bonds payable outstanding, with a remaining discount balance of $3,081. The company can buy the bonds in the open market for $95. So here we have the face value of the bonds being retired, which is 100,000, less the discount of 3,081 equals our carrying amount of bonds payable of 96,919. Then we're going to take out the market price, which was 95,000, and to find that we take the 100,000 times 95% gave us the 95,000, and then that leaves us with our gain on retirement of bonds payable, and the gain is $1,919. So the journal entry to record the retirement includes a gain on retirement of the bonds. So here we have a debit to bonds payable for 100,000, a credit to discount on bonds payable for 3,081, a credit to gain on retirement of bonds payable for 1919, and cash has a credit of 95,000. And we retired bonds payable prior to maturity. Does anybody have any questions on this one? No? Okay. All right, so report liabilities on the balance sheet.
Yeah.
So how are liabilities reported on the balance sheet? At the end of each period, all current and long-term liabilities are reported on the balance sheet. So When a company issues bonds, a discount or premium will be included in this section with the bonds payable. So here we're looking at a balance sheet. We're looking at the liability section. And if you see down close to the bottom, under long-term liabilities, we have this bonds payable for $100,000 right here. And then there's also a discount as well. So there was a discount on this one. So we're showing the discount down here as well. That's where it will fall on our balance sheet. We're going to use the debt to equity ratio to evaluate business performance. The relationship between total liabilities and total equity is called the debt to equity ratio. The debt to equity ratio shows the proportion of total liabilities to total equity. This ratio measures your financial leverage. A ratio greater than 1 indicates that the company is financing more assets with debt than with equity. So how do we use the debt to equity ratio to evaluate business performance? Green Mountain Coffee Roasters reported total liabilities and total equity in thousands on its fiscal 2013 annual report as follows. So here we're saying that on September 2013, total liabilities were this, total equity was this. In 2012, our liabilities was this, and our equity was this. So did our liabilities go up or down from year to year?
No, way, down.
They went down. Yeah, I know, because you normally you would think first year, second year. So just pay attention to that when you are looking at your problems, and that's why I asked that question. Because this is actually the current year, and this is the prior year. So for the current year, our liabilities are 11. I'm just going to say that. And in the prior year, our liabilities were 13. So our liabilities went down. Ugh. And then our equity currently is 26. Last year it was 22, so our equity went up. That's supposed to be an arrow. It looks like a palm tree. So just pay attention to the way that the dates and where they fall. The worst is to know how to do something, and it's just like a small little error, and it just totally messes everything up. All right, so Green Mountain's debt to equity ratio for September 2013 is calculated as follows. So this is a formula, and it's also in your book on page 615. But so we calculate the debt to equity ratio by taking the total liabilities divided by total equity. So we took their total liabilities, divided that by their total equity, and this is telling us that their debt to equity ratio is 0.43. So Green Mountain's debt to equity ratio is well below 1, indicating that the company is financing more assets with equity than with debt. So what do you think, as far as the debt to equity ratio, would you want your debt to equity ratio to be high or low? Low. You want a low debt to equity ratio. Yeah. So using the time value of money to compute the present value of future amounts. What is the time value of money, and how is the present value of the future amount calculated? $1 received today is worth more than $1 received in the future, hopefully. The fact that when we invest cash it earns interest over time. This is called the time value of money. And the time value of money is used to determine the present value of a bond and its market price. So the time value of money concepts, it depends on some key factors. Depends on the principal amount, the number of periods, and the interest rate. So the principal amount, you will normally see that, bless you, you will normally see the principal amount with a lowercase p. So if you see that, that's telling you that they're talking, this is the principal amount. The number of periods normally is an N, and the interest rate is normally an I. So the principal amount is the amount of the investment or borrowing. It's normally either a lump sum or an annuity. And an annuity is just a stream of equal cash payments that are made at equal time intervals. The number of periods is the length of time, and the interest rate is the percentage earned or invested. There are different types of interest. We have simple interest and we have compound interest. Simple interest is calculated only on the principal amount. It's the simplest way to calculate it. Compound interest is where interest is calculated on the principal and all previously earned interest. So compound interest is a little bit more difficult to calculate, but it normally tends to have a better, I guess it depends on who you are, if you're the one paying the interest or you're the one receiving the interest. So I'm just not going to say that. Because if you're paying the interest, you probably prefer simple interest. And we're going to see an example right here. So here we're comparing simple interest versus compound interest. We have $10,000 at 6% for 5 years. So when your next loan you're looking at getting, or even like if there's credit cards or mortgages or anything like that, you want to pay attention to the type of interest too, because it could be simple interest or it could be compound interest. And a 6% interest rate, as you can see, can be different depending on if it's simple or compound. And if you have the option to make that choice or go with a different company, I mean, it could even be depending on the amount of the overall loan. Both of these, we're currently comparing 6%, right? And we're saying it's 6% for simple. Our total interest is $3,000, but it's 33 over here. Okay, so it might be that maybe a 6% loan here, maybe we might be able to afford a 6.2% there, and maybe they have some other perks or something. You never know. So there's a lot of factors that roll into, you know, making these financial decisions, especially if interest is involved and what your final interest expense is going to be and all that kind of stuff. With simple interest, so what we've done here is we've multiplied the 10,000 by the 6%. So for simple interest, that's just simply what it is, $600. Every year, $600 until we get to that 5th year, and that's the last payment, and the total that we've paid is $3,000. Simple. Compound interest is a little more challenging, and you're probably, if you have a problem like this, which I'm pretty sure you have a problem somewhere on compound interest, you're going to want to refer back to this slide because it's easy for you to see how they're doing this, because they've got it kind of laid out for us here. This is slide 55. So compound interest, they took the 10,000 the first year, multiplied it by 6%, and our compound interest for the first year is 600. Then the next year rolls around. So we're going to take the 10,000 plus the 6. times 6%. And that gives us 636. And then the next year, we take the 10,000 plus the 6, and this line is so thick I don't want to draw over it, but plus the same 6 from up here, plus the 636 from here, and then multiply that by 6%, and that gives us 674. The next year, the 10,000 plus the first 600, the second 636, the third 674 times 6% gives us 715. So you see the pattern. So that's how you would calculate the compound interest. So every year we're adding all of the prior compound interest amounts and then multiplying them by 6%. Simple interest, we just simply multiply 10,000 by 6%. Compound interest, we are compounding on top of the prior interest. So our total interest at the end of the 5 years for simple is 3,000. Our total interest at the end of the 5 years for compound is $3,383. Are there any questions about this one? Okay. It can be confusing. That's why I'm saying come back to this slide. Because looking at it right now, it probably hopefully makes sense. But if you were to just get a question about it, you know, a week from now when you're working on it, because this is chapter 12, I don't want you, you know, just remember, refer back to this slide, 55. All right, present value of a lump sum. So how much would you need to invest today in the present time to have $13,383 in 5 years if the interest rate is 6%? We're going to use the present value factor from the table, present value of $1, which is located in our appendix. So if we flip to the back of our books, we have an appendix back there. Somewhere, here it is. I can't really tell you what page because they're all like lettered and numbered, but it's B, which is after A. A has a lot of numbers, so it's like A48 is the last number, and then right after A, you'll have the appendix B, which shows the present value table. So flip through all the A's. Yes. Yeah. Does it give you, do you have a page number prior to that? What? Or,
Just a B1.
Okay, same thing. I wasn't sure. So that's the table. You will have to refer to this table for some of your questions. So I just want to make sure that everybody knows where to go to find it, how to find it. I have some sticky notes if you want to mark, like sticky note it in your book so that it's easier for you to find it later. Yes. Okay. Yeah, I have a sticky note in my book for it. Does anyone else want a sticky note? That way you don't have to find it later. You want to? There you go. Anyone else? Okay. And
Is chapter 12 open to us yet?
not yet.
Okay.
You need one too?
I have
To just mark it? Okay. All right. No, chapter 12 is not open. It opens next week, but since we're covering it now, I'll go ahead and open it after class. But just do chapter 11 first because chapter 11 is due Friday. All right. So in the book, we see present value. Let's see, it's telling us to use the present value of $1. So you'll see here, you've got present value of $1 listed on your table. And what you would do is you would look here for the number of periods and the percent. So this is saying 5 years at 6%. So if you look down 5 for periods and then you go over to 6%, that should take you to 0.747 in your table that's in your book. And that's the factor that you would use to solve this problem. Is everybody able to find that in your present value table? Is anyone not able to find that in your present value table?
Oh, what page is it?
It's in the back of the book. It's after A48. It looks like this right here. I just want to make sure everyone can look the values up correctly, because you're going to have to do this for a couple of problems. And it's hard to explain over an email or a phone call. So. I'm just going to walk around real quick, just in case. So for that one, so we're looking, so the number of periods is 5, and then the percent is 6. So we're going to scroll over, and that's the percent, that's the factor that we would use, 0.747 right there. And did you find it? You know how to, perfect. And you got it? You know how to find it? 7.5 is the period, and then 6%. Yeah, so the period's 5, and then 6% is the percentage rate. So you're gonna look for the period 5 and then 6%. So that's the factor that you'll use right there. You know how to? Yeah, perfect. Are y'all able to find it? Yes, and so you'll go down to the 5th period and then over 6%, so that's the present value factor that you use, 7.747. And you've got it as well? Okay, perfect. I want to make sure, because I don't want you guys to leave and then I didn't show you where to find that. It is very hard to explain through an email. All right, so we've got our factor. So the factor is 0.747. So what we're going to do next is we're going to use that to calculate the present value. So to calculate the present value, we have future value times present value factor for I. I is interest, equals 6%, and N, number of periods, equals 5. So we're going to plug everything into our formula. So our future value, we have 13,383. And we looked based on number being 5 and percent being 6. We looked in our table, and it told us that 0.747 was the factor that we would use. So 13,383 times 0.747 gives us $9,997. And that is our present value. Does anyone have any questions on this? Okay. All right, present value of an annuity. So a series of equal payments over equal intervals is an annuity. Assume instead of receiving a lump sum at the end of 5 years, you receive $2,000 at the end of each year. So we've got our present value equals the amount of each inflow times the annuity present value factor for I, which is 6%, and the number of periods is 5. So first, we have to go and find our annuity value. So if you turn the page in your book, the other table that's listed here is the present value of an ordinary annuity. So you're going to look for number 5, and the percent is 6, and that should give you 4.212. And that's how you know, that's how you'll find the factor that you're going to use for the annuity. So just keep that in mind, because there's two different tables in the book. So depending on what you're looking for, that tells you what table to go to. And these amounts are different. So if we go to period 5 at 5%, on the first table, that's 0.784, but on the second table, that's 4.3. It's a very big difference in if you were to use the wrong number. It would give you a very, very, very big difference. So make sure that you double check and ensure that you're on the right table based on the problem that you're answering. So to calculate this, we're going to take the amount of each cash inflow. They tell us that we're receiving $2,000 at the end of every year. So annually, $2,000. So we take 2,000 times this factor that we found in our book, and that gives us $8,424. That's the present value of the annuity. So we can use the present value. Does anybody have any questions about that? Sorry. Okay. We can use the present value of a lump sum and present value of an annuity concept to determine the selling price of a bond. The present value of a bond, its market price, is the sum of the present value of the principal amount to be paid at maturity and the present value of the future stated interest payments, which is an annuity. Assume the following information. Smart Touch Learning issues 100,000 of 5-year 9% bonds that pay interest semi-annually. The market interest rate is 10%. We have our maturity payment, which is 100,000. Periodic interest, which is 4,500. Interest rate of 10% equals 5% semi-annually, because semi-annually is half the year. And the number of periods, there are 10 because payments are made twice a year because it's semi-annual and it's a 5-year. So you're going to have 10 payments. So make sure that you keep that in mind, because you will have a problem or two as well, similar to that, where this problem is saying we have a 5-year bond that's semi-annual, and down here, some people might just put, okay, it's 5 years, so it's 5 payments, but you really have to just keep in mind, because it's semi-annual, it's actually going to be 10 payments. So the present value of bonds payable issued at a discount. Oh no, did I close my page? There we go. This is on page 620. So present value of principal. To find this is a good slide to come back on because it's listing out the three different formulas. So to find the present value of principal, you take the future value times the present value factor for I, which equals 5%, and N equals 10%. Sorry, I like have something in my throat. And so we found our factor and we plugged that in, and we've got 100,000 times 0.614, which gives us 61,400. Present value of stated interest. the present value equals the amount of each cash flow times the annuity present value factor for the interest, which is 5%, and then the number of periods is 10%. So we went in and we looked and we found that that annuity factor is 7.722. So we're going to take the 100,000 times the 9% times it's semi-annual, so 6/12. And then we're going to multiply that by our annuity factor of 7.722, and that's going to give us 34,749. All right, present value of bonds payable. So for this one, we have the present value. To find that, it equals present value of principal plus present value of stated interest. So we take the principal, which we calculated here. We take the present value of the stated interest, which we calculated here. And that gives us our total present value of the bonds payable. So notice that the stated interest rate, 9% times 6/12 equals 4.5%, which is half of 9. This is not the market interest rate of 5%, which is used to calculate the amount of each cash flow for interest. This is because the bonds payable pay interest based on the rate stated in the contract, not the market. So we're going to assume the following information. Smart Touch Learning issues 100,000 5-year 9% bonds that pay interest semi-annually. The market interest rate is 10%. So we've got our maturity payment of 100,000, periodic interest at 4,500. We've got our interest rate at 8%, and we've got our number of periods, which is 10 periods. These payments are twice a year for 5 years, so that means we're going to pay them 10 times. So to calculate that, we plugged the numbers in here. We looked for our factor, and this gave us our answers. I would try to rework this. Maybe like at home, like try to like remember to go to these slides. This is slide 61. So this is a question, and then you plug everything in based on you remembering how to plug it in. When you go to the next slide, this shows you exactly how they got the answer. So I would probably try to use this as just a practice question, and then there's the one prior to that too that we talked about. This one right here is good as well. Work through those maybe like once after. I mean, we just went over the other one, so we're not going to work through it, but work through it maybe once just to see how everything flows. Does anyone have any questions on those? No? Okay. So journalized transactions for bonds payable. So earlier we used a straight line approach for amortizing the discount and determining interest expense. The effective interest amortization method computes interest expense based on the carrying amount of the bond and the market rate at issuance. So Smart Touch Learning issues 100,000 9% bonds at a time when the market rate of interest is 10%. The interest expense is calculated using the carrying amount of the bonds and the market interest rate. So here we have bonds payable, discount amortization schedule, effective interest amortization method. And this is on 623. Yes. So they tell us here how we calculate each of these. So the cash paid, we took the face value times the stated interest rate times the time, and that gave us our cash paid. So 100,000 times 9% times 6/12 gave us 4,500. Our interest expense, they tell us to calculate that. We took the carrying amount times our market interest rate times the time. So 96,149 times 10% times 6/12 gives us $4,807. But discount amortized, we took interest expense minus cash paid, which equals 4,807 minus the 4,500 cash paid, gives us the $307. And then for carrying amount, we took the 96,149 plus the 307 discount, which gives us a new carrying amount of 96,456. So that's how we would calculate each of those. This is also a good reference. And then it shows it laid out in the amortization schedule as well. Are there any questions about this? All right. So using the discount amortization table, record Smart Touch Learning's first interest payment on June 30th. We're going to debit interest expense by the 4,807, credit discounts on bonds payable for 307, and we're going to credit cash for 4,500. And they show us here how we calculate that as well. It was also on this prior one, so I'm not going to read through those again, but it's listed out here too. So Smart Touch Learning issues 100,000 9% bonds at a time when the market rate of interest is 8%. So we're issuing at 9%, the market rate is 8%. The interest expense is calculated using the carrying amount of the bonds and the market interest rate, similar to the method that we use for discounted bonds. We have bonds payable premium amortization schedule. And this is on 624. For this one, same thing. So they're telling us how they computed everything. So for cash, we took the face value times the stated interest rate times the time. So 100,000 times 9% times 6/12 equals 4,500. For the interest expense, we took the carrying amount times the market interest rate times the time. So we took $104,100 times 8% times 6/12, which gives us 4,164. For the premium amortized, we took the cash paid minus the interest expense. So 4,500 minus 4,164 leaves us with 336. And then the carrying amount, we took carrying amount minus premium amortized. So the 104,100 minus 336 leaves us with 103,764 carrying amount. So that's how we calculated that one. Does anyone have any questions on this one? No? And then Using the premium amortization table, record Smart Touch Learning's first interest payment on June 30th. So we debit interest expense for $4,164. We debit the premium on bonds payable for $336. We credit cash for $4,500, and they're showing us the calculations here as well. They also showed us on the prior page. And then our note is that we paid semi-annual interest and amortized premium. Does anybody have any questions? No? We do have a couple problems that we're going to do. So we're going to do a couple of problems.